let's welcome our market master for the morning. It's a very important morning, Dhanteras morning. Joining us is Vetri Subramaniam, Group President and Head Equities at UTI Asset Management. Good morning, Vetri. Nice to see you in your festive gear. A very happy Diwali to you and everyone at UTI as well. What does summer 2076 hold for you? Does it look like a better year for investors?
Thanks, Lata, and greetings to you and the team and all the viewers today. Well, it's always hard to sort of figure out what the year ahead has in store. When I look at the column more, I look at it in terms of where the issues are and what the problems are. Clearly, we've got a growth slowdown which is underway. We've got problems on the credit side, and it seems to me, anecdotally based on conversations we are having with companies, that there are significant issues in terms of access to credit which are holding the economy back. Thankfully, in the last 6 weeks, we've seen a lot of action from the government in terms of trying to address some of the sore points, some of the bottlenecks, trying to smoothen things. But I think it's going to be a very gradual recovery in terms of growth here onwards. As far as the markets are concerned, valuations aren't really particularly cheap, though there is a lot of divergence in the valuations, and we can talk about that later. So, I think all in all, it continues to look like a little bit of a challenging environment.
Okay, Vetri, hi, good morning. Season's greetings from my side as well. So, that's the big question for the market has been whether you stick to the companies which are delivering growth but are, so expensive, the likes of Lever or Jubilant Foodwork, or do you dabble into the beaten down names like an RBL Bank or an IndusInd Bank? What's your thought process?
So just two, three things over there, Anuj. First is, my instinct, and I've typically had a bit of a value, sort of instinct or bias over the years, is to always look at areas when there are problems, because it's only when the problems emerge that two things happen. The stocks in that sector or in that area tend to get much cheaper in terms of valuations. The implied growth expectations tend to collapse, which again makes it attractive. And secondly, what people sometimes fail to recognize is that when a sector goes through significant pain, the stronger names which manage to come through that difficult period actually end up growing much faster as things start to normalize. And I do believe that over time things do tend to normalize. So therefore, my sort of inherent bias is to look at those areas to see where are the companies where the market sort of completely underestimating the sort of longer term growth potential, but with one caveat, and I think that's an important caveat. I think what history has taught us is that during difficult times like this, when there are credit issues, there are capital squeeze issues, you want to stay with those companies which have the balance sheet and the cash flows to navigate those challenging times. If you don't have a strong balance sheet, you're excessively leveraged, you've got a problem in terms of accessing credit, then the risk is that you don't make it to the starting line the next time things start to improve for the economy. So with that caveat in mind, my bias as an investor is to sort of look for some of those beaten down sectors, stocks, and try to see where the mispricing is emerging. But honestly, that hasn't paid too well in the last few months. But again, I'm not surprised. History tells me that when things start getting beaten down, they sometimes surprise you by getting beaten down a lot more. But you just have to be willing to take that pain as a value investor.
Okay. By the way, the stock that's really surging now because of earnings is PNB Housing Finance. Just get that stock up for you. It's up almost about 10% odd. At least that's what I saw. Look at that, 10% higher on that stock. Vetri, hi, good morning. I want to ask you about NBFCs, but before that, this market has tasted blood after the corporate tax cut came through. And now expectations are of a personal income tax cut, some maybe land and labor reforms, etc. Although there is no fiscal headroom, you think the government could bite the bullet on issues like personal income tax cut?
So let's just step back a moment, Sonia. I think talk about simplifying and cutting our income tax rate and the corporate tax rate are, proposals have been around for more than a decade. I think the original direct tax code talked about it more than 10 or 11 years ago, and then it's gone through many avatars, though largely I would say it's one single avatar, but just with different authors. And eventually what we've got this time around is the government decision to implement 2 or 3 ideas which have been part of all the DTC codes and various versions that we've seen of it on the corporate tax side. My sense is, and given that I think they've announced October end, the budget consultation process will start, they may look at doing something on the personal tax side in the budget in February. But what I would really hope for is that whatever they do to the entire tax structure, it should not be piecemeal. Look at the the message that's coming from all the authors of these various versions of the DTC, which is to simplify things, get rid of the exemptions, bring the tax rates down so that you incentivize people to come within the system rather than arbitraging the system by choosing to stay out because their profitability is a function of the high tax rates which incentivize them to stay outside the tax system. I think that's the broad message that various authors have placed over the years, and I'd like to see more holistic implementation of the direct tax code rather than pick and choose single elements just to keep different segments of either the larger citizenry or for that matter the markets. I mean, the market is the wrong god to be addressing as far as these issues are concerned.
Yeah, no, that point is taken. I mean, those principles that you speak are really sound, but the effort to do that in the indirect tax has probably not yet yielded results, probably because of poor implementation or whatever teething troubles. Let's hope they do better with direct taxes. But Vetri, which part of the market will you bet on now? Are you happy with the consumption stocks performance? Do you believe they have troughed out? I mean, consumption as an activity has troughed out. Will you go for these stocks?
Again, speaking more from the point of view of the strategies that I'm directly involved in, and as I said, my sort of value bias, I find it difficult to get too excited about some of the consumption names at a top-down level. So we are pretty underweight in many of the consumption names. We do own 1 or 2 where we think the longer-term growth potential is extremely attractive, and those stocks are again not cheap. They've run up, but we had the benefit of getting into them at times where their valuations were more comforting, and so we're happy to sort of ride along some of those positions. But certainly, I think my strategies with the value bias do not have a significant overweight, because I think some of these valuations are very, very challenging. When I look at what the track record of those companies over the last 10 years in terms of revenue growth or EBITDA growth has been, and what is now implied by those valuations, then I'm not really able to very convincingly justify to myself that these valuations are well placed. And as I said, again, my preference is always to look for areas which investors are fleeing, because that's where the opportunities arise for a value investor.
Okay, Vetri, you may not want to talk stock specific, but your thoughts on this recent whistleblower controversy in Infosys and how all of a sudden so much market cap gets damaged.
Yeah, I mean, I can't really say much about the stock, but I think this is a new thing that the market is having to grapple with in terms of what happens when these disclosures come through. And I guess some bit of precedence will also have to build in, because I think there's a debate about when these things should be announced to the exchange, when it should be announced to investors. And I think you have to also look at the fact that from the company's point of view, there has to be some due diligence which happens. You can't be reporting various allegations received on a daily basis, just as you would in, for example, announce the institutional investors that you were meeting on a daily basis. There has to be some check and balance before a company decides that something is serious enough to then communicate it. But yes, I mean, even as an investor, it was a bit of a shock to see the way the market sort of digested that. To my mind, it also reflects in some part the fragility in the minds of investors, where, I think particularly over the last year and a half, the focus has come on so many issues related to balance sheet, related to governance, evidence that the ability and appetite to absorb any sort of negative news is very, very limited on the part of many investors.
Oh, absolutely, and this is a stock, to be fair, has given great returns to investors in the past, so no harm taking a bit of profits here. But Vetri, you know, the other space I wanted to ask you about was infrastructure and capital goods, because there's a bit of a dichotomy here. L&T reported very good numbers, you know, they beat estimates on their guidance, etc. But their commentary was very cautious. They said private capex has not picked up at all. How do you decode this, and do you like this space in general?
So, you know, I think 2 points to make here. Let's face it, I think the sort of enthusiasm of the entrepreneurs, the animal spirits of the entrepreneurs, even though I was hoping that, you know, the corporate tax rate would sort of get them a little bit excited, the fact remains that I think entrepreneur spirits remain quite dampened. Many of them are continuing to deal with issues related to past investments they've made. They're having to deleverage, and as the whole system starts to clean up, I think many of them are facing challenges related to, you know, past deeds, not necessarily misdeeds, but just the way past financial decisions and structuring transactions were made. So it's not clear to me that private entrepreneurs and private balance sheets, particularly in areas like infrastructure, have the kind of appetite to go out and invest. And even if they wanted to, I'm not sure the financial system has any great appetite to go out and lend. You know, I think Lata talked about, you know, the indirect tax changes that we made momentously about 2 years ago, and how implementation has proved to be a challenge. You know, 2.5 years after IBC, what we'd like to be talking about is the fact that the IBC process has worked smoothly, excellently, but we can't say that. You know, it's all been tied up in various issues. Now, you know, very well-learned lawyers tell me that this is part and parcel of how any new law takes birth. The courts will have to figure out precedents, but the fact remains that it's been a disappointment, I think, both to the banks as well as to those who have bid for those assets. So under those circumstances, it is not clear to me that private entrepreneurs and balance sheets really have great appetite to go into large infrastructure investments. And remember, we are asking companies to increasingly focus and banks to focus on lending based on cash flow, right? And what we've actually seen in India is where people have taken a risk to build a business based on exposure to the sovereign, right? So if you do a power plant based on a PPA, it is technically cash flow based investment that you've made. And these are, many of these businesses, whether it's highways, whether it is roads, whether it is power, have all run into problem because those contracts have then started to be questioned. So, you know, I think we've sort of broken the model on how do we go about funding and driving infrastructure, and I don't think the entrepreneur spirits are up to the level where they would be willing to commit significant amounts of capital to infrastructure.
I can take your point, whether it's the judicial system or the legal system or the sheer ability to implement law and order, those have been the biggest roadblocks, not necessarily economic slowdown. Economic slowdown perhaps is the result of all these issues. But Vetri, just a final question. I think earnings growth has been, there has been a drought of earnings growth from what, 2012? We've had low single digit or middling single digit kind of earnings growth. Is that likely to end any time now? Are we on to something better? I did see rural food inflation rising. We have seen government spending. We have seen plenty of cash in the interbank market thanks to RBI. Do you see earnings returning, double digits?
So, first of all, Lata, keep in mind that, sometimes forecasts are more reactionary than that we realize. So, we need to be careful about interpreting it. But let me just give you another point over here. Back of the envelope on September 20th, which is when I think the corporate tax rate was cut, just back of the envelope on an Excel sheet, it seemed to us that the Nifty should get a lift of anywhere between, 5% to 7% in earnings growth, simply because of the benefits of the tax, moving through individual companies. But when I actually look at the Bloomberg consensus earnings estimates over the last month or so, there is no bump up at all, because what has happened is that I think growth has been such a disappointment for many of the earnings estimates that people have simultaneously cut their growth estimates, cut their EBITDA margin estimates, given the benefit of the tax cut, and on an aggregate basis there is no bump up in earnings that we are seeing over the last 1 month. So I am sorry to say, but it's not clear to me that FY20 is going to look particularly different in terms of earnings outcomes, and even those earnings outcomes, mind you, continue to be dominated by a handful of financials which are creating a swing in the reported earnings numbers. So sadly, I think we are over to 21 to now figure out what earnings in India will look like.
Okay.